So thank you all very much for coming. I'm Lily Fry with the Electronic Cash Transfer Learning Action Network, or ELAN. So many of you are probably familiar with the ELAN, but for those of you who aren't, we're a network of private sector entities and humanitarian agencies that have a common goal. Oops, and I have to turn the clicker on if I want it to work. Of improving the effectiveness and impact of humanitarian cash transfers through the effective use of payments technology. And for the last year and a half, we've been pursuing the research that we'll be presenting today that contributes to looking at when and under what circumstances people who receive electronic transfers via mobile money accounts choose to use those accounts in more detailed ways, and what are kind of the barriers and enabling factors that contribute to that. To eventually get toward this goal of understanding how to make emergency transfers as effective as possible and to use payments as effectively as possible. I'll introduce Christine Martin, who will be our moderator for today's panel, and she works with the USAID Global Development Lab and will be introducing each of our panelists.
Great. Thanks, Lily. So I am going to do just a brief introduction to the topic. Some of you might be, have heard me say all of this a lot, but I'm going to say it again. So again, I'm Chrissy. If you don't know me, I work for USAID. I work on our digital financial services team. There are different sectoral goals. So I work with our Bureau for Food Security and Agriculture, and in this context, work with Office for Food for Peace, Laura, who's here, and Office for Foreign Disaster Assistance and Food for Peace. I totally just combined your names. To think about the role that digital payments and financial inclusion can play in humanitarian response. And so I think what we saw from the little brief exercise, that activity that Bree introduced, is that understanding any new system isn't always easy, and certainly not when we're talking about a new payment system immediately after a disaster. But at the same time, we know that millions of dollars of humanitarian aid are delivered through cash every year. And often, even when it's done digitally, it's done through these closed-loop, one-off systems. People get the money, they throw away the card, and we reinvest in a whole new payment system next time. And it's frankly a waste of donor money. The person has to learn a new system then multiple times, not just once or twice. And so I think we do see an opportunity, if done right, that mobile money can provide a sustainable, locally driven solution for people to either receive the next aid payment or maybe get a loan or make a remittance payment in the future if they so choose. So, as many of you know, we saw this opportunity and USAID helped to bring together a bunch of our partners to develop a set of principles that really try to get at this intersection and work out, where is this kind of fine line between the fact that humanitarian response, it's not their job to promote financial inclusion, and it's not the number one goal and never will be. But there is an opportunity here, and what role can the development sector and the financial inclusion practitioners play in helping to set up these pathways? And with those principles in mind, I think these case studies are just perfectly well timed and couldn't be more useful to really dig into a lot of the details of the challenges that we face and how different programs are overcoming them. As I was reading them, I was reliving some of my experiences in Haiti in 2010, trying to make mobile money payments after the earthquake. And there was this, of course, we just set up mobile money, and all of a sudden it'll be really easy to get aid out to people in Haiti. And it was incredibly difficult. Unfortunately, a lot of the challenges are the same. And so I think the more we document and share and discuss, the better off we'll be for the future and not kind of repeating the same mistakes or challenges. So hopefully this is one part of the effort of really helping to map out an effective way forward. So the agenda today is that I'm done speaking. I'll introduce the three panelists who will go over in detail for about 10 minutes each case study. We'll have time after that for audience Q&As just on those countries, more like clarifying questions. And then bring our panel up to really discuss what did we learn from looking at all three countries at the same time, what are the common themes, what are the differences, what should we be taking forward for the next time, and then we will have more of a Q&A and discussion. So we're going to start off with Marcella. Marcella is a consultant with Strategic Impact Advisors. She works a lot with us at USAID on mobile money and financial inclusion issues and has a ton of experience in this area and led the case study research for actually two of the case studies, Bangladesh and Zimbabwe, but today we'll be presenting specifically on Bangladesh. After her, we're going to have Brian Hunter, who was running Save the Children's operations in Zimbabwe for 3 years as the country director when this was happening, and has lots of experience in the field as well. So we'll have a lot to share. And for Ethiopia, we're going to have Thea, who works for Mercy Corps, really focusing on financial inclusion, especially in conflict and areas and protracted crises. So and then after their presentations, we're going to be joined by Sylvia, who works for CGAP and also has done a ton of research on consumer adoption of mobile payments and what are the consumer protection issues and a lot of the user issues that we experience when trying to introduce mobile money for the first time. So she's going to help us put the findings into context and really bring in lessons from a lot of other countries and contexts besides just these three. So with that, I will welcome Marcella up.
Thank you. Thank you, Chrissy. So do I need to speak into this, or do I have this microphone? Okay. So thank you, Elan, as well, for organizing this event today, because I think these case studies are really interesting, and I think there are a lot of really good learnings from this. So today I'm going to talk about the case study in particular in Bangladesh, and as many of you know, Bangladesh is one of the most vulnerable countries prone to recurring environmental disasters, cyclones, typhoons, flooding, year after year. And this project was implemented by Action contre la faim, ACF, who started working in Bangladesh in 2007. And they have a variety of projects around health, water and sanitation, around food security and livelihoods, disaster and climate and risk management. And in 2015, they implemented two particular projects, one in Shaktira, which is the one on the, see if I can do the pointer. Whoops, I will forget the pointer. Shaktira was an area where they are chronically affected by flooding, and so this project was in particular for organizing cash for work activities for risk mitigation and improvement of food security, and it's focused on the most vulnerable landless laborers and farmers. And this project was something that was ongoing for about a year. The project in Cox's Bazar down on the southern coast was a very short-term emergency relief project that was really trying to focus on meeting basic needs with unconditional cash transfers to people who were affected by a tropical storm and flooding and landslides. So one note in terms of both of these projects is ACF, they chose to use mobile money transfers in particular for their own organizational benefits that they expected from transferring those risks of cash handling from the organization over to the mobile financial service providers. So in the design and implementation of these projects, there were no intentions at all to ensure that their e-transfer recipients had access to additional financial services or were able to continue using their mobile SIM cards or their mobile wallets. And that's, I think, really important. In terms of both of those programs, they were quite different in some ways. The Shaktira project took place over a year. There were 2,300 beneficiaries of that project, and they received 1 to 4 transfers from mobile money. The project in Cox's Bazar was a very short program for 3 months, and it was really an emergency program where 1,334 people received up to 2 transfers. And they both ended up using bCash as their mobile financial services provider in the end. They both had local partners that were helping them with the implementation. And I think one thing that's really important to note is that Bangladesh has a cash or a bank-led mobile financial services market, which many of you are aware of. And that means that they have to first register their recipients with mobile SIM cards, and then they have to register their recipients with mobile wallets. And that meant that ACF also had to do procurement with two types of service providers, mobile network operators and mobile financial service providers. So it took them quite a while. It took about 4 months to do that full procurement. And because of that registration, it meant that many of the recipients received cash for those first transfers. So in the end, in Cox's Bazar, people only received one mobile e-transfer, which is important to note. Just some quick information about the mobile financial services context. The financial inclusion or adults with financial institution accounts, 43%, which is relatively high. Either a mobile money account at 9%, a bank account, or non-bank mobile financial or microfinance institution account. The market for supply side is pretty developed. There are 18 banks providing mobile financial services, about 600,000 mobile money agents, 9 mobile network operators, and there are 90 million unique mobile subscribers, which is about 80% of the adult population. So it's not a nascent market for mobile financial services. In terms of sort of the survey participant profile, just some quick figures. The survey included 50 participants, 25 from each project, 84% women. There were also focus group discussions. There were 2 in each area, 1 fully male focus group and 1 with women. In terms of sort of the profile, the population nationally is about 60% literacy rate. People in these groups were a little bit higher. In terms of average income, they were a little bit lower than the national GDP per capita, which would be about $100 a month. In terms of distance to mobile money agents in Shaktira, it was much more, oh my goodness, I'm running out of time. It was much closer at about 30 minutes on average than in Cox's Bazar. And people in terms of having mobile phones, the survey asked people for access to mobile phones in Shaktira. It was pretty high at 88%, only 48% in Cox's Bazar. But access has one gender component, which many people told us about, and that in a household there may be 2 phones. One phone may be owned by the husband in the family. The other phone might be a family phone. So the woman may have access to that phone, but it's used by everyone in the family, including the children. So in terms of being able to actually control and manage a mobile wallet through that phone might be a challenge. In terms of the focus group discussions, 91% of those people said they owned phones. 10 people actually were able to obtain a phone or were gifted a phone somehow because of this program, because they wanted to be able to control their cash transfer. So before and after, before there was not much use of mobile money services. There were questions about using mobile money transfers, which is the most popular use for mobile money. Only about 18 to 26% said they used it, and in many of those cases it was really over the counter. So if you're not aware, in Bangladesh, over-the-counter mobile money transfers are very popular, which means that people don't necessarily need to have their own wallet to do those mobile transfers, but are using an agent and the agent's wallet. So that was much more popular. Unfortunately, we didn't get that question afterwards. It got left off the survey. In terms of savings with mobile money, there were 0 people who used it before, and afterwards there were 6 people who said they retained some of their savings, some of their cash transfer in their mobile wallet. In terms of other additional services, there were 0 people using it to purchase goods and services or airtime. Afterwards, there was a slight increase. So there wasn't a lot of uptake. However, what I think is really important here is that the question about awareness. People, 48% only said that they were aware of mobile money services or any of the mobile money service providers before this program, these programs. Afterwards, of course, there was 100%. So I think that's really important because if you look at the customer journey, the first, in terms of mobile financial adoption, the first step is awareness, and I think that's really important. So my quick takeaways, I think it's really important to be realistic in terms of our expectations about driving adoption with mobile money, humanitarian e-transfers, for a couple of reasons. One, they're often very short-term projects. For example, in Cox's Bazar was only for 3 months. It doesn't give people a lot of time to practice. And there were only 2 to 4 transfers, and this is typical often in cash transfer programs where people in Cox's Bazar only received 1 e-transfer, some of them up to 4, but it doesn't give people a lot of time to become accustomed to something that's new. Also, we're working usually with people in the most vulnerable areas, people who have lower literacy skills. It's much more challenging to adopt technology that's completely new. And of course, in humanitarian assistance, depending on the type of emergency, it may be that you're trying to really just meet basic needs. So the focus might not necessarily be on helping people to adopt mobile money services. However, there was low adoption. However, I think that there was some, which I find encouraging. And I think the most encouraging thing I found is that people's interest in learning more about mobile financial services was very high. Especially in the focus groups, I was really struck by the fact that people, when we asked them if you are using the mobile wallet for things like airtime or purchasing goods and services, and many people didn't know that that was a possibility, and often they asked us to show them how to do it. So I think there was a high interest in learning. 82% of the survey respondents said that they would be incentivized to use their wallets more by having training. There was actually no practical training done for either of the programs. They did basic orientation in terms of this is how you cash out, this is how you store your SIM card, this is how you keep your PIN secret, but they didn't have any practical training. So I think there were a lot of people who were quite interested and expressed that interest in wanting to learn more. There was a preference for e-transfers amongst the participants in Shaktira. 92% said they would prefer e-transfers over cash going forward. In Cox's Bazar, it was only 24%. And I think that one of the reasons there might be because in Cox's Bazar, people only had 1 e-transfer. So they didn't necessarily get a chance to see how it really worked and build their confidence in that. Let's see, I'm gonna stay here. I think, especially my final point, in market contexts like Bangladesh, where you have recurring natural disasters and you're continually providing humanitarian assistance, often to the same populations, which ACF said they did work in Shaktira on many projects again and again with some of the same recipients, that a simple redesign of adding some practical training could really create a lot of benefits beyond just helping increase adoption. But one of the points that Chrissy made earlier is for humanitarian agencies, it provides them the ability to more quickly respond in future disasters because that payment mechanism is in place and because the recipients are already used to using it and familiar with mobile money services. And so the costs presumably could come down because you're not going in and spending that time and that cost to set up a new payment mechanism and to do the training for a new payment mechanism each time. So it would also potentially enable those recipients to be able to have another financial management tool so that they can help manage those shocks on their own, that they can help build their own resilience. So I think those would be my final takeaways there. And I'm going to pass it over to, I think, Brian.
I'm really disappointed I didn't get a golden horn this morning. Although that would have been a little bit of a conflict of interest because I kind of knew what was going on there. I was informed, so. But I'm honest. It's a pleasure to be here. I'm going to talk a little bit about the case study, and I'm sure all of you have already read all the details of the case studies. So if you have, then you may hear some things repeated from that in this presentation. So as mentioned, I was in Zimbabwe 2012, 2016 as the country director when the USAID-funded Emergency Food Security Program was implemented, and the study here is related to the work that we did under that program. For those who know Zimbabwe, we've had a chronic, mostly seasonal food insecurity really since about 2002, when there was a significant decline in agricultural production and a restructure of markets and the agricultural system in Zim. Extreme food shortages every single year, really exacerbated in 2008, 2009, when we had the cholera epidemic as well, and sort of a worsening of the political crisis as well. Also affected severely by a very high prevalence rate of HIV/AIDS. So every single year, especially the October to March lean season before the harvest, you would have seasonal programs to support families in consumption. In 2014-15 agricultural season, there was a 51% decline in production, in maize production from the previous year. So that's why we implemented this program. A very interesting case in Zimbabwe, where we had every year this seasonal assistance was provided in in-kind commodities, mostly from the World Food Program. And that would be including in the districts of Binga and Kariba, where we introduced this mobile money response. The situation, it's a very interesting scenario where we have had a very traditional response over many years, since 2002, with in-kind food distribution, usually unconditional. At the same time, a very dynamic financial services sector and infrastructure for digital payments. Interestingly, 17% of adults hold an account at a formal financial institution, a banking account, but 22% of adults have mobile money accounts. So this was kind of unusual. It is an unusual case. Very traditional response, yet the infrastructure there for a more advanced response. 91% of adults had heard of mobile money. The coverage was also very good, a penetration rate of 96.5% of mobile coverage. Unique mobile subscribers of 9.8 million over the population of 14 million. 85% of the adult population was subscribing to mobile services when we entered. So probably a unique situation in Zimbabwe. Very traditional response, yet the infrastructure there and the use of mobile services. This is the program in Binga and Kariba district. So this was to cover consumption needs in the lean season, which is basically October to March. So we had 6 transfers, 6,750 households, about 30,000 people. The cash transfer amount was $28. I believe that at the time was going to cover about 2/3 of the daily kilocalorie requirements of a family of 5 or 6. The donor on this was USAID, the Emergency Food Security Program. We had, in this program, it wasn't only unconditional, it was mostly conditional cash. And about 10% of the beneficiaries were unconditional. And the conditionality was related to cash for training or cash for work. And the training was about conservation agriculture. So it was a little bit trying to push to the resilience agenda on this program. So our participants they were selected through a typical vulnerability ranking process. The households were categorized as labor constrained or non-labor constrained. As I said, the labor constrained households, about 10% of the total population that we served, were receiving unconditional cash transfers, and the others were doing the cash for work or cash for training activities. About 2/3 of the respondents to the survey earned less than $20 a month and relied on the cash transfers as the main source of income during the program period. Some of you know Zimbabwe literacy rates are very high in general, like an 84% rate of literacy amongst adults in Zimbabwe. But the population that we were serving, that was quite a bit lower, with effective literacy rates around 25% of full literacy. The majority of the respondents did some sort of saving, informal, mostly grain storage or livestock was their form of saving. And 20%, so it was a fairly high number, 20% of survey respondents had used mobile money transfers to send or receive funds before the EFSP was implemented. But none were using it to save. So savings was done through their traditional mechanisms of grain and livestock, but not the mobile money to do saving. Other participants reporting mobile money use for purchasing goods. So 8% of the participants would be using it to purchase goods, or airtime, about 9% as well. So takeaways. We did see that there was a pretty significant increase of the use of mobile money products and services between the start and the conclusion of the EFSP. We weren't starting from nothing, but there was quite a significant increase. Average rates of usage for mobile money services increased from 6% pre-project to 26% post-project. I think it's important to mention with the case of Zimbabwe, so this was implemented towards the end of 2014 into 2015, and the case study wasn't done until a year later. So the respondents, the survey respondents, and the group discussions of which the information for the case study comes were a year later after the conclusion of the project. The biggest increase in usage were related to saving. So nobody was using the service for saving, and by the end of the project, 27% were using the mobile service for saving. And money transfers went from those who were actively using 11% that were actively using till the end of the project, 74% were using the money transfer function. Project participants also doubled ownership of the mobile phones during the project. So we did not give away mobile phones. We made a decision not to do this for a couple of reasons. So that it was only the SIM card that we gave, and then it was either there was a large percent that had mobile phones, or they borrowed, or they used the agent's phone, but they had their own SIM card. There was also a notable increase from 8 to 26% in the use of the mobile money accounts for purchasing goods. We have currently, although the problem is quite a bit exacerbated now compared to when this case study was done, but liquidity constraints. There were liquidity constraints of the agents during the program implementation, and then liquidity has progressively gotten a lot worse in Zimbabwe. But it wasn't as it is today, where you don't find very much cash. So the agents' liquidity constraints did force some participants to purchase goods. So the agents were the traders, and so they purchased goods instead of receiving the cash, and they purchased the goods from the agents' stores. In Zimbabwe and other liquidity-constrained contexts, liquidity limitations and their effects should be carefully monitored. However, I think that as we saw, so at the end of the EFSP, we did continue to use mobile money, and we used an ECHO funding to continue this work. We found actually that as the liquidity crisis worsened, we had more direct purchasing of goods from the beneficiaries. So as other populations suffered from the liquidity crisis, actually our beneficiaries in the ECHO project really had no real impact because they were purchasing goods directly with the mobile money. So we were telling, of course, USAID that was a very positive thing that we had introduced a couple of years before that actually increased. My theory, of course, is that it increases resilience of those families who were later affected by the much worse El Nino-related drought 2 years later. The other point that I want to make here is that this worked very nicely because of the partnership that we had with EchoNet, that was the mobile service provider. And the great thing about the partnership was that they felt that their business strategy aligned very well with the program. So their expansion of coverage in those areas was successful for them. And of course, as others took up the mobile money response in later years funded by DFID and ECHO, of course, they saw increased benefits of that. They're really dominating the market. So this was great for them as well. And I'm 1 minute over. So thank you so much. I'm passing it on to Tia now, right? Right. Oops. Yep.
Hi, everybody. I'm excited to talk about some of the work that we've been doing in Somalia. This is specifically in the Somali and Afar regions, which is in eastern Ethiopia. This is a little bit of a unique case because as the previous cases, the work had been done and we went back and looked a year later. Whereas in this example, we were actually able to collect the data in real time. It was part of we actually designed this specific initiative for continued use of mobile money after the cash transfer program. So it provides us a little bit more of real-time data. So the context, this was in response to actually a drought that had started in 2005, then going back to what Brian was saying, actually similar, the 2006 El Nino-induced drought. So it was a cash transfer specifically looking at providing funding for food security and for nutrition. The reason this initiative is actually, we were able to leverage a program that Mercy Corps has been working on in the region for several years that's actually funded by USAID, linked to pastoralist market system development programs that are linked to pastoralist value chains. And as a part of that, what Mercy Corps has been doing the past 5-6 years is really building up the financial infrastructure in that region. So as part of the larger initiative, we've been working to establish 2 microfinance institutions, and it also introduced mobile money to the region in partnership with a company called Bell Cash Technology Solutions. So as part of this cash transfer program, we were actually able to build on, one, those existing partnerships, which I think had a huge impact, as well as that financial infrastructure was already in place, or we were able to scale it in the response. One of the reasons that we've focused so much in that previous program on financial services is just, quite honestly, there's just such a low bank penetration in Ethiopia. Right now, there's only 22% of adults can actually access formal accounts. Overall, in Ethiopia, the mobile penetration, especially in East Africa, is fairly low. It's around 43%. In the part of Ethiopia where we did the cash transfer work, it was much, much lower. We found that only around 10% of the recipients actually had current access to a mobile phone. And for mobile money in Ethiopia, there's very different numbers, but it's usually right now, I think in the capital, it's maybe 10%, but out in the regions where we were, it's usually around 1% are actually using mobile money, though it is growing very quickly. Ethiopia is also unique in the sense that there's one telecom. It's a government-owned telecom. And just overall mobile money and agent banking is still very nascent in the country. Regulations were just passed in 2012. Similar to the Bangladesh model, it's also very much a bank-led model, which also makes, to be honest with you, accessing a mobile money account multiple steps. So first of all, getting the SIM card and then having to register with a bank or an MFI that's already been approved by the government. The other issue is that you have to have an ID, national ID, to both get the SIM as well as open an account, which has been a huge issue for us for working in years in Ethiopia, which is something I'll talk about a little bit later, which we got very engaged in for the mobile money accounts. So the program itself, it was 6 months. It was just last year, so around this time last year. The total number of recipients for receiving cash transfer was actually 5,000, but of that, 2,000 received electronic cash transfers, because this case study is part of actually larger research that we're doing in the region linked to cash and financial services and household resilience. So we chose specifically 2,000 that would receive the electronic cash. 3 transfers, $45 each. And the service provider was the Somali Microfinance Institution, which is based in the Somali region of Ethiopia, which is a partner that we've been working with for several years and helped establish, as well as a mobile service. The mobile money service is called Hello Cash, which is one of just 2 or 3 operating right now in Ethiopia globally. Donor was USAID, and we were the implementer. I think a couple of things that really made this program unique, again, as I said, we actually designed it for continued usage of mobile money products. So one, we actually did subsidize the phone and the SIM card. One of the things that we did is because we only found that 10% of people in the region had phones, we, Mercy Corps, subsidized half the cost, 50% of the cost, and then the recipients could either have could have the remaining balance taken out of the first transfer or spread across all 3 transfers. This was not a requirement. They did not have to do this, but 99% did purchase the phone. We also assisted heavily with the IDs, and that was the MFI actually did that, which is something they're very used to, just even with their current clients. There weren't mobile agents actually operating in the specific area, but again, looks similar to the Zimbabwe example, the Hello Cash and the MFI really saw this as a potential market opportunity and to expand their market coverage. So they were willing to set up their agents alongside the electronic cash transfers. 4, we actually did spend a lot of time on training. We could have spent more time on training, but we actually did spend time on training. So one, just due to the fact that this was the mobile phone itself was new to most of the recipients, did training on the use of the phone, use on the account. There's also extremely low literacy levels. So quite honestly, a lot of visuals. You see on the slide I just had, one of the visuals, obviously this is in English, but just explaining even how mobile money works, because this was a very new concept to a lot of people, understanding that the money is in the phone. There was lots of different posters and these different things that were used and that the agents had to explain how mobile money worked. And the other piece too is that we actually required or strongly requested that a minimum balance be saved on the account, so not fully cashed out. And that was around $4 that we requested. And that was really to promote familiarity with the MFI account and encourage storage of funds. I wouldn't say savings at this point. I think at this point it's just storing funds on the account. Since this is part of a larger research initiative, we do have some figures on the pre-project. Again, there really is a complete dearth of formal financial services in this region. So no surprise, pretty much most of the savings before had been with traders, a huge amount of asset purchase, especially livestock, jewelry, saving at home. There is quite a bit of money transfers, both nationally and cross-border. Most were informal, some were formal. There's a couple of larger remittance agencies, but not as much. Borrowing, informal, and mobile money usage, again, extremely limited throughout the country, but especially in this region, and only 10% actually had phones before. So post-project, because we were able to collect the data in real time, one of the things is we looked at the data points after the first transfer, the second transfer, and the third transfer, and we're continuing to monitor monthly. After the second transfer, we were really excited actually to see that 43% actually stored money above the required minimum. And when I say required, we actually had no way to require this, but we strongly requested it. And most people actually did do that, the majority did. But then some even saved above that, which was really encouraging for us. After the third transfer, that had been reduced to around 13%, and right now it's holding at about 10%. But we still are actually very encouraged by that, considering this is a very new service for a lot of the populations. One thing that we are seeing, though, even though the storage is only at 10%, a huge percent are still using it to receive and send transfers, which, again, we're very encouraged by, and the majority are using it to top up their SIM card as well. So for this, some of the barriers that we found, which I think Marcella had mentioned in hers as well, is that one of the reasons that people had said, even though there was a sense, we found people of feeling secure with saving some of the money on the phone, is that people needed the cash. This is a severe drought. People actually needed the cash, and that's why they were fully cashing out. Some of the other barriers that just has taken, and it still takes time, is just the lack of familiarity with using the phone in general, but then also using the mobile money account. So that just takes quite a bit of training and a lot of time for the agents as well to be engaged, as well as the microfinance. Just limited knowledge of Hello Cash products because people weren't familiar with mobile money, weren't familiar that you could actually send, receive money, the topping up, all that's just a process that takes time. And then we had ongoing, quite honestly, network and electricity problems, I think, which is common in a lot of cash transfer programs, and some queuing at agents as well, which quite honestly are things that we would learn and we could do better. Actually, the MFI and Hello Cash would be able to do better next time. But some of the enabling factors, and again, we were happy with the results, is just people actually saw there's a utility and of having this option of other options they'll probably continue to use of storing money digitally and the sending and receiving money. One of the huge enabling factors is really the trust in agents. As I mentioned, they set up the agents alongside the e-transfer program, and there's just a lot of trust in the agents, obviously, so that really allowed us to, for example, the agents were having to do all the PINs, having to do a lot of the transactions, but people did not necessarily feel uncomfortable with that. Again, the training, I think, was a huge piece. The phone ownership, we wouldn't have been able to do it electronically if we hadn't probably have subsidized that initial piece. And then the frequency. 3 transfers is obviously not a lot of transfers, but it is enough. It is 3 opportunities to develop comfort with the mechanism. And it really, more than anything, what we found in the focus group discussions, and it really, really sparked interest in, one, using the phone for other means, for information, obviously, information in general, as well as for mobile money, but just understanding the different financial services that are available to them potentially. So I will save my takeaways for the Q&A because Bree is flashing me. But I think some of the takeaways are very similar, and I think it'll be good to kind of compare the 3, considering very, very different situations, but there's some very clear similarities, but also some clear differences, and how do we adapt that when we're trying to move forward and actually have the uptake of mobile money be one of the key pieces of these types of programming.
Great, so thanks for all the presentations. I think that gave quite a good overview of a lot of the details and very much the different contexts that we covered. We did want to give, before I launch into a couple pre-prepared questions to pull out common themes, we wanted to give a chance for any kind of clarifying Q&A that you had after, because that was a lot of content. Does anyone have any questions right now?
Sasha Kapadia from MasterCard. Thank you again for this really informative set of presentations. For those participants in your programs that already had familiarity with mobile money, did you ask as to what was the impetus for them to adopt that initial usage? Was it because they wanted to receive a remittance or send a remittance, or they had access to a government social benefit program? What's your understanding of this base level of interaction with this technology, and how can we encourage that sort of adoption going forward?
I guess I'll just say, I think you mean before even having this e-transfer, I think there were, the predominant use was money transfers, what I saw. I can't think of the exact numbers. I think it was like 26% of these recipients had used mobile money transfers before, but they hadn't really used any other services. So to me, that means that would be the driver. I don't think that, we didn't ask if people already had other like government cash transfers or were receiving any kinds of payments like that regularly, but I don't think that they were in the Bangladesh case. So to me, it looks like it was really the money transfer as a driver. But again, in Bangladesh, I think a lot of people were using it over the counter. It was difficult to deep dive and get that level of information, because sometimes when you ask people, are you using money transfers, mobile money transfers, they would say yes. And if you really started the conversation, you would realize, oh, they're just using it over the counter, but not with their own account. So, but I think that was the driver in Bangladesh in any case.
For Zim, it would be the remittances. So this was, a vulnerable, poor area in the northwest. We didn't ask the question, but almost certainly it would have been for remittances. There was 20% usage. It was for transferring money. It was almost entirely receiving money. Interestingly, around the time of the program implementation, they opened up the possibility of, all the Zimbabweans that are in South Africa working. They send their remittances back to Zim, and during the program implementation, it became possible for those transfers to happen directly from South Africa to way out in Binga. But it wasn't those who had already, that wasn't available for those when we started the program, but it just accelerated the progress, really, of, the benefit of doing that. You get all the Zimbabweans and South Africans sending those remittances directly and so much more cheaply.
And I would just say, even though we were using the products before, it was also the transfers, both to send and receive transfers. But then we also asked for those that were storing money on the account after the first and second transfer. Almost half of them that did save, which is around 43%, said they wanted to save proactively. Also, they found it convenient, and also just for security.
Hamilton McNutt, I'm a partner of Marcella's at SIA. I have a quick question. I thought it was interesting, Thea, you said that agents were an enabler. In a lot of cases, they aren't an enabler.
I knew there was a controversial statement.
Yeah, so I was curious, in Zimbabwe and Bangladesh, if they were seen as enablers or if it was sort of a neutral point, and B, in Ethiopia, why do you feel, what was it about them being started with the program that kind of helped with that trust?
Sure. No, and part of it also is because we also said the agents were set up close to where people lived as well, which I think you guys can give the examples, but I know a lot of places where, we find even outside these examples, one of the reasons that it can be low uptake is just the distance to going to an agent. So that was part of the design as well. So the agents were close by. The agents were set up. Hello Cash specifically chose agents that were, quite honestly, leaders in the community that had stores people already were going to, felt comfortable with. So again, it wasn't going, I know in the Bangladesh example, people going to someone that they've never met before, maybe to a different part of the city, which is a very different experience versus going to the place you're already going to with the agent. And I think one of the things that we found is that the agent, just through the digital literacy, but also illiteracy, people did rely quite a bit on the agent. It was on their phone, but people had a lot of issues with forgetting their PIN numbers. Again, things we'd find not just in cash transfers, but overall with mobile money. But we did not find at all, which actually surprised us when we were asking, people didn't seem to mind that they were actually having to give some of that information to the agent, and they felt trust in the agents, and they also felt trust actually in the bank account as well.
I think in Bangladesh, one interesting point about that is that for women in particular, they said that it was challenging for them because to go to the market and visit an agent required them to have a male counterpart, a male family member to go with them. And so they didn't find that very convenient because most of the agents were men and it meant traveling. So for women, I think it was, probably that's a barrier. For men, it was still like 30 minutes to over an hour for people to get there. So in some areas, it was definitely not very convenient for people to get there. For some, the agents are located in the market and the men are visiting and doing the marketing anyway, so it wasn't such an issue. And they did seek advice and guidance from the agents. But I think for the women in particular, it's a barrier.
Did you all find that the trust in the agents was more or less important than just general trust in the service provider? I know Zimbabwe is obviously a unique case here. Mm-hmm. Did people generally trust the service provider, or did it really only matter if they trusted the agent that they were actually interacting with?
I think for Ethiopia, it's a bit of both. The microfinance institution, Somali microfinance institution, has a high number of branches, in the area. So people potentially were familiar. It's one of the only formal financial services providers. So if people were familiar with it, pretty much everyone focuses on livestock and in trading. So I think there was some familiarity. But I think it really, for us, I think a lot of it had to do with the agents.
And maybe to pick up on, my mic's working? I don't think so. Well, to pick up on this, you all stressed that the training of recipients was key, and that you saw that this would be also something to increase and to highlight. But was there also training for the agents, especially if there were new agents or agents that were not used to serve this type of customers? Were there also aspects where you could talk about training the agents?
Yeah, we had, so as we started, there were about 20 agents in the 2 districts, and very quickly it got up to 120. So there's a lot of new agents that hadn't done this before. They get enough, you get $500 you have to have as like a deposit to become an agent. So it was a rapid increase. And all of these agents were traders. Like the beauty of this program was that the economic stimulation happened as these traders, they said, okay, I'm going to save a little bit, I'm going to set up my store, I'm going to become an agent. But there are a lot of glitches at the beginning, really understanding what they can and can't do. But I mean, in our case, the private sector partner, EchoNet, they just really saw this as their business objective. And they got 20 to 120, from 20 to 120 agents out there, and they invested in the training of the agents and partnered with us, and they created something called a brand ambassador that sat alongside with us and manned the help desks and everything to assist with the training on the use of the technology. They took the responsibility over their agents, and we had a mutual responsibility over the participants, program participants. But it wasn't enough, and I think that's sort of the conclusion that comes out of this, that you're not going to get to that point where you have such familiarity with the use of the technology that it's self-sustaining, because we wanted to get as much of this money into the pockets of the beneficiaries. And so we limited some of these things that we could have done that we would have wanted to do. And in our case, there was no goal. At the beginning of the project, there was absolutely no goal that we would reach financial inclusion or financial literacy with these participants. It came as a bit of an afterthought, actually.
And Sylvia, how does this echo some of the experiences that you've looked at CGAP?
Well, we do see that the role of the agents is key, because they are the primary interface that recipients have in order to cash out, because we can't deny that cashing out is still the very first and priority use case for recipients, especially if they are onboarded on digital financial services for the first time. And that's why we see in the research that we've done that agents have a very significant role, and unfortunately, very often this role is not performed very well. So we see that there are a lot of clinches happening at the agents, and which includes some involuntarily performed clinches that they really are not trained enough. They can't help them with a problem. They don't know whom to contact. If, for example, a recipient lost their PIN, or if a recipient lost their card in the cases where there are cards, or they just don't know how to use the service. So sometimes they can't help them. Then also not knowing that they should never ask them for the PIN, that they shouldn't enter the PIN, is also a really important learning that agents have to know. Waking them up at night, they have to know, no, never look at the PIN of someone, and actually teach people to not show the PIN, right? And then we also have cases where they actually defraud recipients, where they charge them unauthorized fees, or they deduct some money without telling the recipients, because recipients are often vulnerable, they don't understand the systems. And so it's a question that I have in general, also looking at who is training the agents, who feels responsible for it, should it be the provider at all times, what role are the programs playing, because many times providers say, well, we are just doing this for the fee we are getting from the program, and they're not really seeing the business case. And I find that really interesting in especially 2 of your cases where you say that the providers were quite interested in this, and they saw a business case in expanding their customer base. And so maybe you can talk again about this. Why do you think this was really interesting for them? Was it also because of the fee that it got from the program, or was it really that they had an interest to expand their customer base?
In the Ethiopia example, they had a very high appetite to expand, and this was an opportunity to do that. So it really was, if they weren't interested in doing that, we probably would not have been able to do electronic cash transfers because it was such a nascent market, we would have just been starting from scratch. I think going back to the earlier question too, is that it was the responsibility of the service provider to hire the agents and train the agents, because again, they were looking at this as a long-term, financial commitment. I would also say, in this situation, because it was a drought, it was slow onset, we also had time to plan. This wasn't an earthquake where we were setting up transfers that needed to go out in 2 weeks. So I think that also does make a bit of difference in the sense that there was time to actually be hiring and doing some of these training of the agents and plan out the business case versus this is an acute emergency scenario that we need to respond to in 48 hours. So I think that also provides some of the time to actually do the training on both sides.
So just quickly, in the Bangladesh case, for the mobile network operator, they did not see this as an interesting business case because they found that when people stopped using, they didn't continuously use their SIM card and it went dormant, and for them that was a loss because they couldn't regenerate that. And so they were not so interested. Bcash, the microfinance or the mobile financial service provider, they said they were interested, but they didn't necessarily make a lot of effort because I don't think they saw it as a huge case. I mean, these were pretty small projects, right? So, and so on one hand, they say that it's interesting for them to partner with NGOs to do these kinds of cash transfers, didn't necessarily make extra investments in that. But I don't know. I also remember speaking with the folks, the EcoCash people in Zimbabwe, and they said that it really was beneficial for their business case in building out into the rural areas, and they really put an emphasis on putting the ambassadors out there to help people. So
Yeah.
I was impressed in comparing the two different cases, how much more action you saw behind the service provider.
And I think in the end, the fees were fine. I mean, after this case, I mean, DFID and Echo, they start doing cash-only responses. And, EchoNet was perfectly set up. And their business, actually, now they're getting lots of fees. DFID is putting 25 million pounds through the same thing. We started with $3 million. And I think their fees are covering their costs, and it's allowing them to expand their business dramatically into the rural areas. So it's really a win-win for them.
I would just say it just stresses the importance of preparedness in the sense that we were able, because we had these existing partnerships with the microfinance institution as well as with this mobile provider. It really allowed us, the trust was already there. Again, we weren't knocking on their door right after the emergency happens. We've been working with them for several years. I've actually helped them actually make the business case to even move out to this part of Ethiopia several years ago in a non-emergency situation. But I think that really helps as well, just with the partnership, because you can sign as many contracts as you want, but what's actually going to happen with the rollout, it really allowed that flexibility and that trust between all the partners as well.
So one barrier that we haven't discussed as much, but that often comes up, is just the registration and the legal requirements for know your own customer KYC regulations in the country. Was that a barrier in these cases? Was something that was easy to overcome? Can you speak a little bit more about that in each of the cases?
So in Bangladesh, I mean, it was a challenge because it's bank-led, and so it was incredible to hear how much effort ACF and their local partners put into getting participants registered for the SIM card and then going through that whole process again to register for their mobile money wallet. And so they had to have a national ID card. Of all of those participants, 82 were not able to get a mobile money account because they didn't have an ID. It was about 2% of the survey respondents. So it was a barrier, and now I think it's become even more of a challenge. In Bangladesh, they said they've put in a requirement for a biometric identification in addition to the national ID. So in Bangladesh, it was clearly a challenge. But in most cases, it was overcome, but that's because the NGO really are the ones that help the recipients do it. without that help, it would be much more challenging for people to fill out that form and get their ID and get the photocopy and get the photos. So I think that's a huge benefit that NGOs provide.
In our case, I mean, everyone's got a national ID in Zim, so that wasn't a problem, but they also required the proof of residency. I think early on we tried to get sort of a blanket from the village chief, a letter saying, all these people are, residents here, and that would have sufficed, but they didn't accept that, so we had to go individually, so one by one. And we needed to invest quite a bit. I mean, we had a very fast startup on this. It was within a month we were up. We had done a pilot before with EchoNet, so we had some experience with them. But that was a big thing that it was like that critical path method. The longest piece was to get that information from each individual participant before we could actually make the transfer. But the national ID is not a problem. But again, Zimbabwe is a special case. Probably nobody has such great coverage of national ID, where the government knows everybody and where they are.
So in Ethiopia, yeah, it's a huge issue, but it's something that the Somali MFI has to deal with their clients. So they have the relationships and partnerships in place with the local government to be able to facilitate those. So as part of the process, again, it's bank-led, so there was 2 steps with the SIM and with that. And so the MFI actually handled most of those aspects, because that's something we'd been working with them, again, for years to do, because outside of the mobile money, it's something even to open up the bank accounts that's required.
So this was great discussion, and we're going to open it up to audience questions, but we're going to kick it off first with Sylvia, just again pulling a few more experiences globally, and then just leave it to you all to continue.
Great. Yeah, so as you heard, I'm working at CGAP, and I've been working on digital cash transfers for quite a while. Originally starting some work with WFP in Kenya, and now also looking more at government transfers. And originally, we were very interested in learning more about the consumer experience and looking at what are the experiences of first-time users when they try to access and use their payments. And this was primarily done from a consumer protection perspective, looking at what are the risks and how can those risks actually undermine any positive perception of those services. And I was just talking before about this, that if you want to encourage people to use digital financial services, digital bulk payments can be kind of an enabler, a push factor, but then this experience has to be really positive so that it actually makes them think, oh, this is of value for me. This is better than what I've been using before. And so we really thought, looking at the landscape and looking at so many new engagements, new initiatives that digitize payments to poor populations, we realized there's really something we have to work on to provide some more guidance and find practical solutions and good practices and how can this be done better, especially for poor populations. And so at CGAP, we think that there are basically 2 rails that can enable broader adoption and usage of digital financial services and digital bulk payments. And so the first rail that we think is important, and this looks maybe a little bit complicated, so I'm basically talking about it. You can see it also in the back and on the sides, right? So we think the first rail that you have to move on is to get the basics right and to ensure that consumers have a positive experience and that they perceive the digital payment service as secure, as reliable, as something convenient, and that there is a recourse channel where they can solve problems. The other rail goes beyond those basics and enables that customers have an empowering experience so that they actually, through using those digital financial services, they receive greater control over the finances, more choice, they receive a voice, and they also experience respect. So it's basically now a model that we are thinking of that combines consumer protection with customer centricity and customer empowerment. which are two very strong work streams within CGAP. So we are basically working together, Gayatri, Murthy, and I, on looking at good practices to make this possible. And we think that one of the main barriers that we have in digital bulk payments is still that usually there is a business relationship between the program and the provider. And recipients are still seen as beneficiaries and not as customers. And so our idea is now to provide a framework that allows to actually move this, continuously shift that relationship to a business relationship between the provider and the customer. Let's make customers out of recipients. And making them to customers means that we provide them with value services, that providers really see a business case in serving them. And so actually, after seeing those 3 case studies, I was really encouraged, and I saw that many of the experiences and evidence that we see in other countries and other cases is confirmed again, and it also really emphasizes again our hypothesis. And so I picked like 4 main insights that we saw in those 3 case studies and that we think are really important. And so the first one is really that we still don't get the basics right in many cases. Electricity, network connectivity, liquidity. I mean, if a service I'm using that relies on those basics is not reliable, then I don't blame anyone for not using it, right? And so we really have to work on those aspects. And an example is, for example, in Malawi, Airtel Malawi, they actually made an agreement with their banking providers to provide additional liquidity to their agents during the disbursement periods. And also in Uganda, MTN actually added new network towers in previously really weak catchment areas, and 5 were only for the SAISH program, which is a huge G2P program there. Then another aspect is that considerable training and practice increases the familiarity with the service, and it also increases their independent usage and their feeling of control and security in using the service. And so, as we mentioned before, bulk payment recipients are often the most vulnerable. They have low levels of literacy, of tech savviness, and also they don't really know a formal financial service, and especially not digital financial services. And so they seldomly feel that they have control over the financial service they are using. They rely on assistance, often ask agents, and that's also a risk of being defrauded. And so it's really important for program managers as well as the payment service providers to provide frequent, repetitive training that is interactive, that takes them in, also design the products more to their needs and to their habits. And so what we've seen, for example, in Pakistan, in the BIS program, they realized that the main beneficiaries are women. Most of them are illiterate. And they realized that they hardly understood how to use an agent, how to use the services, and relied heavily on assistance. And so this was mainly because of insufficient communication. The product design was not really tailored to their needs. And so they actually applied human-centered design in order to adapt the services, a mobile financial service, to their needs and what is easier for them to use. And also developed a communications campaign and some education seminars for them to be more independent in using the services. And in the end, it really increased their ability to use the services themselves. Similarly, in Peru, in the Juntos program, they also realized that people hardly knew about mobile agents, about branches, how to use an ATM, and so they also developed, together with the payment service provider, with the banks, their communication campaign and also a training. interactive workshops. Then we also saw in those case studies that the context really matters. What is the habit of the recipients? What's their familiarity with using digital financial services or formal financial services? Also, what are their preferences? It's very different in every context. And so we really need to understand what they need, what they are familiar with, and then look at what can be of value to them. So what we see, what really helps is to have a two-way dialogue, to frequently interact with recipients and use that interaction and that feedback in order to improve your program and improve your products. So for example, WFP Kenya, with whom I've worked quite a bit, and we did a lot of behavioral research and also assessed their revealed preferences. And we saw that, for example, recipients in more rural areas, they prefer the mobile payment service because mobile agents, mobile money agents were much closer to where they live. But then especially women in the more urban areas, they prefer to have a bank card because they said, the bank card is under my control. I'm, as the household, as the female household head, have this card, and everybody in the family knows this card is reserved for family needs. And so there are very different preferences that we often do not see. They're very different for each individual. And so we really promote to look at options where you can provide choice to recipients. Then lastly, I think we have seen in two of the cases, especially, there is a business case for providers to reach those populations and to serve them, especially providers like mobile network operators who are maybe less interested in the amounts, but more into the frequency and getting new customers that might also primarily use the airtime and SMS maybe. And so another example where we see this is in South Africa, where a bank experienced weekend and month-end crunches because there were a lot of low-income consumers that came to the branch to request their balance, most of all. Do a little bit of banking, but most of all, they just want to know their balance. Now, they saw that 50% of those low-income customers actually had signed up and registered for their mobile banking service, but only 20% of them were using it. So they thought, like, what can we do about this? Because they could actually use the mobile banking application or USSD-based to actually request their balance for free. And so they developed a game for those recipients, for those customers, where they had a quiz, which first of all just asked them questions about, okay, I'm finished in a second, just asked them questions about how they can check their balance on their phone. And then when they did something right and they answered the question right, they got airtime as a little kind of reward. And then they also received a challenge in a second step to actually do it on their phone and check their balance and just practice. We see again the aspect of practicing. And actually, this game increased the amount of customers that check their balance on the mobile app from 0% to 54% after 2 months, and then to 64% after 6 months that they played the game. So we do see that there are also fun ways that banks and providers can use in order to increase the usage and make people more familiar with the service. So basically, right now, we are still working on this model. We are expecting to have a publication on this by fall this year. And we are still looking for good practices and strategies that work to implement such a framework where we really look at those 8 main principles that you see here. And so we are happy if you see good practices in your programs and think you have good ideas that worked well, please reach out to us. I provide you here our 2 email addresses. Really, feel free, reach out to us, share your experiences. CGAP is a knowledge hub, a think tank, and we would love to hear what your experiences are, good experiences or bad experiences, and then hopefully we can share, as we were saying before, really collect a little bit what our good practices are and learnings. Yeah, thanks.
Actually, My name is Colonel Jean. I'm from the USAID Haiti mission. My question for all of you, actually, with your presentation, I see that the contribution that you gave to these rural areas are, you said USD, but do these countries have their own currency? And if they do, I think this is one of the reasons for the rush for everybody to go get their money and not leaving anything on this account, is because I'm sure there will be some fluctuations on their own currency. Meaning that if you were to give them $28 this morning, by tomorrow that $20 may become 27. So definitely, I don't know where the translation take place.
Yeah. So I think all of the services would have delivered the money to the recipient in the local currency, correct?
Yeah.
Which in the case of Zim is the US dollar.
Or at least was.
Yeah, no, it was in Bur. It was in the local currency.
Okay.
Just for the purpose of that, just because not everyone has that, in their head with the.
I think Haiti is a bit, not completely like Zim, but halfway there were there are a lot of USD transactions. So some remittances come in USD, but in I don't think that Digicel, so you can only transact in Haitian, in local currency. So.
I do think, though, that people rush to take it out for two reasons. One, because in one case in Bangladesh anyway, it was an emergency situation where people really had lost everything and really needed to meet basic needs. In another case, I think people also, they're trying to cope with a natural disaster as well, so they need that cash to purchase things, to rebuild. So I think that is one issue in humanitarian assistance. Of course, it's also the trust of a completely new system, but I think also the messaging I noticed in Bangladesh, and I think also in Zimbabwe, if I remember, is that the NGO themselves also don't necessarily say, you can keep your money in there, because they sort of message that you should take out the cash. And so a lot of participants that we talked to said, I didn't know I could do that. And I forget the statistics, but it's in the case studies. So a lot of them said, I didn't know I could leave it in. So it's the messaging as well.
Which is an important point, because it doesn't always line up with the program goals, right? If we want people to buy food, then we actually don't want them to keep money in their account, because it's not what we were giving them money for in the first place. So I think that goes into some of the preparedness, is looking at, do our program incentives actually line up with this?
The interesting thing would be to see post-program, say in the Zim case, after the lean season, people kept their accounts. A lot of them kept their accounts through, after harvest. Now are they using it for saving them, right? So we said we want them to take it all out because it's designed to provide 70% of the kilocalorie requirement. They need it, right? So they're taking it out. But post-program, when they have their harvest, are they using it for savings? That would be interesting. And currency fluctuations would be something that's very relevant. Also, not in the Zim case, but certainly where you have a hyperinflationary environment or fluctuations, it's a consideration.
Yeah. That's why I think longer-term research is required in the sense of tracking these accounts. That's what we'll be doing in Ethiopia. So we're doing it right now, but actually to see that, because it does make sense that maybe people would have very low balances at this point in time, but potentially afterwards, if they do see the value in it versus some of the other channels they're currently using, they would start storing money. Yeah. But it's not obviously at a month-to-month. But I would just say in general, I don't think there was any currency fluctuations during our program, but I think in general that's something we build into the programs, obviously watching very closely. And I think, especially sometimes after acute disasters, I think that could be, in Zimbabwe always, those can be, things that we have to watch and consider.
Great. I think we had another question in the back.
Yeah, Niran Soref with Moonshot Global. I have a couple of questions. One of them is last year in one of the other sectors, Education Alliance, there were people in, I don't remember the exact countries, but they were using similar, more in the public sector, where the government was using that whole transaction process to pay teachers in remote areas using mobile money. And Audra said they don't waste 2 days to go to a place where. Do you think that including the public sector will resolve some of the issues for the mobile? Replicating the models, especially successes in Zimbabwe, but in others, would that accelerate things like that? So I once did an assessment in Zimbabwe for the farmers unions. So when they want to reach all the farmers, especially I think FPU, the biggest one, which has about 90,000 members, that would be a great incentive for them to reach them. So that's one I'd like to see as a model, how much our people replicate. The other thing, mainly in Bangladesh, where women have to come along, their husbands, the biggest problem is that normally the husbands take the money to do other things and the family suffers, So how much, it's not just sort of the digital security, but also the social security aspect. How much of that becomes a hindrance for uptake of such a program? Maybe both CGAP and to the lady who was, Marcel.
Yeah, maybe I'll respond first. So with regard to the public sector's role, this is actually a point that we are looking at in this study as well. So we look at what can providers do, what can payment originators do, but also we are not in a political vacuum. Policymakers can also really play a catalyst role in increasing the adoption and usage of digital financial services. And there are several roles that the public sector plays. So that is on the one hand, it's the regulatory framework from the financial sector, which was mentioned in a few cases also here with regard to the identification requirements for KYC that might pose a challenge in onboarding recipients with very low identification documentation. But then they also can really play a role in making a larger business case and scaling up digital payments by shifting their government salary payments as well as social protection payments. And so I do think there's a huge role, and there is really also in the whole community of practice that we have amongst humanitarians and also social protection people, there is an ambition to share systems and to collaborate more within the countries, that they really use the services or the delivery channels that are already in place. I know from a case in, I think, Tanzania, where they are building a single registry that everybody can use, humanitarians as well as the government is using it, so that you can actually also have a central place where you know the respective account or mobile wallet that recipients use or that citizens use, and really talking about citizens. Yeah.
Oh, absolutely. It's a no-brainer that the next step is paying community health workers. I mean, we're really pushing for that. I mean, it's politically a little bit very, very, very difficult. I mean, government's not paying, right? So that's in the mix as well in Zimbabwe. But I mean, it's very much a no-brainer. It's so difficult to get the community health workers to get, what, $15, they're volunteers, basically. They get a stipend of $15 a month, paid quarterly. And it's to me, it's a no-brainer. And in some of these areas where we're doing this program, of course, the Global Fund and the other donors that are paying these stipends, they're way behind the times. And the same population is demanding to say, why can't we receive money, our stipend payment in the same way? This is so easy. So there's demand for it. It'll happen. Teachers as well. It's going to happen. But there are a few barriers in the present moment.
Yeah, I think the single registry in Kenya and the impact that's potentially going to have on the food response is something that just kind of pay attention to. I don't think we know yet exactly how that's going to help, but they've spent a lot of time and effort trying to get this single registry up and running in Kenya, and now there is a famine response happening, and it's helpful. I don't think all of the vulnerable people have made it into that single registry yet, right? Of course, the people we want to help are always the last to be included in these things. But I think we are almost out of time, so I'm going to wrap it up just by saying I think this is a great discussion and really useful case studies. The kind of discussion that we started with the principals convening we did last year, I think one of the main themes that has really come out is that we all need to be preparing in advance more so that these challenges don't come to the forefront right when people are really feeling the emergency needs. We're working with several of you in the room, so Hamilton and Thea and CRS is also involved in doing some preparedness work in Somalia, Mali, and DRC, one of those countries in Central Africa. So we'll contribute to this body of work. So I think a lot of really good lessons learned coming out that hopefully will make this just a little bit easier next time. So thank you to the panelists and to your organizers. It was a great discussion, and thanks to all of you for coming and participating.